expect that you can be invested for the next 20 years or 30, then it makes sense that you lean more towards aggressive growth side, because you will have the chance to actually also survive the potential amplitudes that markets have. And now let's see how strategic asset allocation looks within European insurers and then also Croatian insurance companies. So the difference is mainly related with the percentage of corporate bonds and unit-linked products that European insurers have significant percentage compared to insurance companies in Croatia. And then Croatian companies have more of government bonds, more of real estate, loans, cash and deposits, and so on. Now back to stages. After this first stage, strategic asset allocation, second stage is security selection within those asset classes. So here, actually, you have to pick within bonds which bonds will you consider, like which government bonds, which corporate bonds, within equities, which equities. And here there are various methods and tools that are being used in terms of making investment decisions, and we will go through them in the next chapter. Third stage, selection of financial instruments and vehicles for the allocation, so which derivatives or instruments will be used. Fourth stage is performance evaluation. So here the main thing is to pick adequate benchmark. And in terms of example of insurance companies, here you will have in insurance companies every year you will have annual planning and budgeting. And that's something that can correlate actually with benchmarking. Why? Because it is showing what the company is expecting from your division in terms of overall business strategy, what you have to deliver so that the company could develop in a way that it plans. And fifth stage is portfolio reallocation, recalibration. Here it's all about the frequency. So how often will we actually consider a reallocation of assets, and then this can be driven externally, meaning that something significant is happening on the markets and you have to react. Or it can be driven internally, meaning that something significant is happening in terms of business strategy. Okay, now second stage of investment process and the methodologies and concepts that are actually being used in terms of picking up the assets that you will invest in actually. Okay, first, macroeconomic analysis. That's the assessment of an economy in general through some kind of key macroeconomic indicators in a way that you will take into consideration historical trends, current situation, and then also project or forecast future movements in GDP growth, in inflation, in unemployment rate, debt to GDP, politics, and so on. As I already mentioned, macroeconomic analysis is being used in terms of creating strategic asset allocation, but also as a base for all of the other analysis. Why? Because it gives you context about the surrounding and environment where some asset is actually operating. Second, fundamental analysis. This is actually the analysis where you want to dive deep into understanding the underlying asset. So what does it mean? You can do fundamental analysis on an economy, on a project, on asset or a company or building whatsoever. But if we are talking about the company, then it means that you want to know everything about the business model that's behind the company, everything about the quality of the management, everything about the supply chain management, key potentials, key risks, industry profile, and similar things. So you're actually doing due diligence, and through that due diligence, you're trying to derive the value of that company or that business. And, yeah?
Sorry, do you probably use discounted cash flow for intrinsic valuation?
Yes. In terms of fundamental analysis, yeah.
Any other methods?
You have, you can do free cash flow to a firm, free cash flow to equity, so it can be DCF, it can be dividend discount model, it can be Gordon growth model. There are like more than a few, but the thing is that you are actually trying to determine the value through cash flows that some kind of asset is delivering.
Do you have any preference to one method or the other regarding intrinsic valuation, like DCF or dividend yield model or something?
It's more that you have to take into consideration the specific context of some company or asset, because it will not be the same for financial companies, it will not be the same for non-financial companies. And so there are kind of differences in business models, and regarding with that, you have to kind of you know, adjust the models. Okay, now, so you're trying, yeah, to get the value, and then when you think about next one, relative peer analysis, here you want to price the asset, and now notice that here we are pricing the asset and here we are valuing. And what's the difference? The difference is actually that within peer analysis you are kind of comparing the asset that you are looking at with the other similar assets in a way that you are trying to find specific growth metrics, financial ratios, investment multiples. And then through comparison, you are trying to derive what the price for the asset that you are looking at would be. Then technical analysis and quantitative analysis. Both of those are not interested whatsoever in underlying assets, in understanding what are the assets that you are actually trying to invest in. Technical analysis is looking at the markets and the movements in prices and volumes. And then you're actually trying to determine momentum for the entrance or exit from positions. So it's more a momentum information game. And yeah, of course, determining trends of movement. And then quantitative analysis, that's something that resembles the most with what you will be doing here during the weekend and the contents that you have. So quantitative analysis is actually a computer-based algorithmic way of making investment decisions. You don't need to know anything about the underlying assets or the markets or the economics or anything. And you're actually trying to gather massive amounts of data and then find patterns and irregularities within those data and make small profits like arbitrage and so on those patterns and irregularities, and then that's how you actually make profit. And now here the example would be the famous quant fund, global hedge fund Renaissance Technologies, and their founder, the founder of Renaissance Technologies is Jim Simmons, mathematician, and they hired their only extraordinary physicists, mathematicians, data scientists, people that know nothing about markets, nothing about economics, and actually they just work with algorithms. How does it work? They make on average 150,000 trades per day, and then you make small profit on each. And on a cumulative basis, it's significant return. So to compare this with fundamental analysis, here you would have as an example Warren Buffett. And if you look at the portfolio of Berkshire Hathaway, then you can actually see that 75% of their stock or equity portfolio is allocated only in 5 stocks. So that's the difference. Here you have a lot of trades, small profits, and then significant return. Actually, the best performing hedge fund ever is Quant Fund Medallion, I think. So yeah, you can look deeper into it. So Now, to summarize it all, when we talk about institutional investment and what would make the overall analysis useful, as George Box said, that essentially all models are wrong, but some can be useful. So what makes a good quality analysis is that you are actually aware and you understand all of the different methods, and then you can combine them, you can kind of integrate parts of them or them whole, and you can also determine which one would be the lead analysis for the specific case that you have. And then also a very important thing is understanding of the findings and results that you get. So that would be it. And now a little bit more about ESG, environmental social governance trends, and how they actually influence the investing. Here on this slide you can see the growth of sustainable debt issuance. So the growth is actually obvious, although there is fragmentation on a global level in terms of ESG when you look at how, and that's also related with investment philosophies, how US is seeing these trends, how European Union is seeing these trends, and then also China and the rest of the world. Here, you can see the information regarding how much would it actually cost, or what the amount would be related with reaching the net zero target by 2050. So of course, estimates differ depending on who's making them, but let's say that on average, the projections are around $3.5 to $4.5 trillion annually. And that would mean actually that by 2050, we should invest on a global level around $100 trillion. And just to give you color and context around that amount, it's similar amount as global GDP, current global GDP, and similar amount as current market capitalization also on a global level. So huge amount. Now also a little bit about how things work with ESG and where everything is coming from, and then what the repercussions are when it comes to institutional investment. So everything is driven and pushed from regulatory side. So Green Deal, EU taxonomy regulation, sustainability finance disclosure regulation, corporate sustainability reporting directive. All of those directives and documents are actually posing some kind of requirements and obligations in front of institutional investors in terms of development and implementation of sustainability-related policies, procedures, integration of the ESG assessment, and then also data disclosure and reporting. So I highlighted a few, let's say, that have a significant role. ESG integration, it's actually the requirement that investors need to develop methodologies and scoring models that will be then integrated into investment decision-making processes. How it looks like? So from research level, security level, portfolio level, it can be quite comprehensive. Then the other two, EU taxonomy regulation and principal adverse impact statement, those are related with data disclosures. So EU taxonomy regulation is related with disclosure of data related with economic activities that are actually eligible or aligned with EU taxonomy. And this is what would be these elements of EU taxonomy screening. So criteria to define if economic activity is eligible or aligned with EU taxonomy. And this last thing, principal adverse impact statement, is also disclosure related with investments that you have within your portfolio and that have negative or adverse impacts on the sustainability and environment and so on. And with that, I would like to close this speech and my presentation. Yeah, I would like to thank you for being here and for your attention. And if you want to reach out, you can. And I wanted to say that I want to best of luck for the weekend and for the contest that's ahead of you. Hope that you're happy, hope that you are ready, and hope that you will have fun.
So if anyone has any questions, I hope you can feel free to ask. If not,
did you know anything about this part of the investment universe, like institutional investment so far? No. No, huh? Yeah.
Maybe a more general question. What is exactly that you do in this industry? Like, how does your job look like?
Yeah, I'm in charge of equity and credit analysis. So I'm in charge of the analysis related with stocks and related with projects and related with everything that's, aside from macroeconomic analysis. Well, yeah, it's interesting, and also the things that you will be doing are more and more needed and more interesting in terms of usage within investment processes. So yeah, I encourage you to do it as much as you can, and then maybe you can also make some kind of great algorithm, maybe like Renaissance. Who knows? Okay, if that's all, if there are no questions, or maybe, no. Okay, then that's it. Thank you very much.